Guys, this is day 2 of ICT Essentials, and today we're going to be covering standard deviations, how I use them, and the types of standard deviations that you can use. So right here I have 3 examples. So our first one is our Wick standard deviation. I really only use the Wick standard deviation if, for any reason, we don't have a clear manipulation leg or we don't have a clear breaker leg, but let's say we have a very large wick, and we all know that wick is manipulation. So we can actually, if it's a high time frame candle, whether it's a weekly, daily, 4-hour, you can actually just use the wick right here because this is going to be your manipulation leg, and then you can cast it out, and then you can see where price is going to likely hit. So you might see all these numbers, -2, -2.5, -1, 0, 1, and you might be wondering, like, what actually do those numbers represent? And I'll be going into that later today. But our second type is our manipulation leg deviation. So this is when you have pretty much a breaker, or you have an A, B, C, D leg. So it makes a low, higher, low, high, lower, low, higher, high, and then you tap into it. And this example, I like to use the manipulation leg to cast out my deviations and anticipate the market maker models. And note that these are not going to be perfect all the time. It is only used to anticipate where we could see potential reversals and potential retracements within the market. Our final one is our breaker leg deviation. So this is our A, B, C, D, but we're going to only use the A to B leg instead of this B to C leg, because our manipulation is going to be the B to C leg, but we can also use the breaker. You can use pretty much any mixture of these, but what's important and what you need to understand is that there are certain narratives to using these. Let's say we have a bigger breaker, but we have a small manipulation. I would rather use the breaker if it's larger than the manipulation to cast it out, because I know that this impulse move up, this swing move up is going to be casted out, and we're going to anticipate a higher expansion. But the final type I'll kind of just be covering real quick is you have your distribution leg deviation. And what the distribution leg deviation is, it's basically the same thing. So you have your right here, so low, high, lower, low, higher, high, lower, low. But what we're focused on is we're focused on casting out the distribution. So when we first distribute and we create this initial leg up that takes out this low, you can use the standard deviations, and you could just use the distribution leg to cast out the distribution and see where you might get a potential entry within the -2, -2.5. So yeah, I'm going to break down a little bit more of the cycles and what they kind of mean. I'm going to be showing you guys my FIB settings, so you're welcome to copy this and kind of use it as yourself, but I'll kind of preface, I mainly focus on the 1, -2.5, -2, -1, and -4 deviations. But if you want to be more precise with it, and you want to, I just prefer to have less lines on my chart. But if you want to be more precise with it, you can have the -3, -3.5, -1.5, and the OTE levels at 0.5 and 0.618. So you're welcome to take a screenshot of these, and yeah. So we'll kind of go over what these phases mean. So when you're in a market maker model, and let's say we have we're in a market maker model, and let's say we have our draw on liquidity is like right here, right? Sorry, this is a pretty shitty thing, but just keep in mind. So when you cast out your deviations, when you use manipulation like breaker, distribution like whatever, between the 0 to 1 and the OT levels is going to be your smart money reversal / your low risk buy. And this is where you'll be able to find entries at the start of the market maker model and use it to target liquidity on the opposing end of the range. The -1 to -1, or sorry, -1.5 to -1 is our first stage accumulation, or our silver bullet zone. And what do I mean by silver bullet zone? This is something that's taught by Trader Dexter, but it's essentially when we come down, reprice lower, and then our silver bullet zone would be the gap that is nested right below the -1 to -1.5. So when we have our accumulation, you understand that it needs to be manipulation, but what will always appear between the -1, -1.5 is a fair value gap that you can use to get a first stage reaccumulation entry, or your silver bullet, which is the first fair value gap to appear after a liquidity sweep or a change in market structure. The second area is a -2, -2.5. In this area, we can expect a second stage reaccumulation, or we can expect a smart money reversal, or sometimes if price is in a hurry to reach the terminus, so our drawn liquidity, then it will close above the -2, -2.5. When we close above a deviation, that tells us that price is likely going to go higher and that there is a quicker speed to be used to get to the drawn liquidity. So this is our second, so -2 to -2.5 is our second stage reaccumulation / smart money reversal. Between -3 to -3.5 can be considered our max range expansion. So when price goes to the -3, -3.5, we can expect some kind of retrace maybe. But if price wants to go higher, then this also is likely an area for another reaccumulation or a smart money reversal. And then -4 to -4.5, -5, you can use as your terminus. So that would be if the -4 lines up with a drawn liquidity, that is a likely area that we can see a smart money reversal. Or like I said, if we're really trending on like a higher time frame and we've already hit the -4, but we're kind of just reaccumulating inside of it, like I'll show you guys examples later. You can also use this to frame entries, but usually if we hit the -4, I don't like to look to long any further or short any further, because I'm going to expect some type of reversal that is going to happen to create another market maker model. So the smart money reversal can happen when we have a high time frame PD array, but we have a low time frame market maker model. So if there's like a gap that's nested right up here, and let's say we have like a drawn liquidity that's down here, then let's say right up here, let's say right up here we're accumulating, and let's say we reach the -4, like right up here, and then we come back down, and then this is your, if we're bullish, if we're bearish, this is going to be your low time frame market maker model, low time frame buy model that you can use, and you can cast out the legs of the manipulation and the breakers to catch this. And if it's even more high confluence or even higher confluence, if it lines up with the -2, -2.5, or the -4. And then basically once this happens, it basically restarts the whole cycle again, and it's if the market cycles, etc. So I'll get into some quick chart examples. I'll show you guys the manipulation leg example, I'll show you guys the breaker example, and then I'll show you guys the distribution leg example, and then I will show you guys the wick example, which I love to use the wick example, because especially on a daily candle, because it helps you predict the high of day or the low of day in a market maker model. So yeah, let's jump into it. Here's our example of our distribution leg. So we'll just title this distribution leg. And honestly, I don't want you to limit yourself and only think that you can use like one type. It really just depends which one lines up better with liquidity. Which one you can realistically use the manipulation leg here, but it doesn't line up with liquidity as well as using the distribution leg. So you kind of have to, like when I said you have to understand narrative, you have to understand where is the liquidity resting, and where have we made a high in the market, and where can we expect price to reverse if we are potentially bearish. So right here, the reason why I'm using this distribution leg, so you have your A, you have your low, high, low, higher high, lower low, and then you come in to our OTE level right above 0.618. And the reason I'm not using this manipulation leg is because it's too small for me to really measure a bigger move, especially when we have a midweek reversal and around Wednesday. So I'm using this distribution leg because obviously it just lines up better with liquidity. But here is where your silver bullet zone is. So this is the fair value gap that appears right when we tap the -1 to 1.5. So this fair value gap is good to get a second stage reaccumulation and then sell down. And then you can use the -2, -2.5 to target your liquidity. And you can see here, this is also, as I said, another reaccumulation zone. So as you can see, once we tap into it, we reaccumulate again. And then once we the reason why I like this is because we have this prominent low made, and this low is between our smart money reversal or our our reaccumulation down here. So this could also look for potential reversal retracement. And then another thing I like to note is when we go into the -3, -4.5, you can expect a retrace into about 50% of the range that we've created when we hit it. So when we go here and we take this, you can see that once we've hit the -4 right here, so not this range, but the reason I'm using this range is because this was the range that was made when we had the -2, -2.5. This was the high that was made on that retracement. But now I want to measure the low at the -4 to -3.5 deviations. And you can see right here, price does again retrace to above 50% of the range. So from this high to this low, you can see once we hit it, we retrace to 50% of the range, and then we dump down to our external range targets, which were these relative equal lows down here. And basically, you can, like, the reason I use like standard deviations as draw on liquidity, but I only use them as draw on liquidity when we have liquidity lining up. So like if we have something like this lining up really nice, we got the -3, -4 right perfectly in between these lows. That's when I really like to use standard deviations, because I understand I can predict the market maker models, and it will give me more confidence in entering on a trade like this. Like I said, the -2, -2.5, yes, it's a smart money reversal, but this is just a low time frame buy model right here. This is a low time frame buy model, but we're inside of a PD array, so you can expect that, you know, this isn't going to be super high confidence for us to reverse unless we're showing more strength in the market and we have draw targets way higher. But yeah, next I'm going to be showing you guys the manipulation leg, and here's a good example of when to use the manipulation leg instead of the breaker leg. So right here you can see, I'm going to zoom in a little bit, we have this low, high, lower low, higher high. But the reason I'm not using this breaker leg is because the manipulation is so much significantly bigger than the breaker that it would make more sense to use the manipulation leg to cast out our deviations. Additionally, you could use this leg, like I'm not like against anybody being like, hey, like why can't I use this one? But as I said, when we have a, like, the reason I'm using this manipulation leg right here is because this is when we usually have our quarterly shift. So at the end of October is usually when we have our seasonal quarterly shift, and around fall. So right here, I'm going to be using this leg, so this manipulation leg right here. And this is just another type of deviation that you can use. But as you can see right here, we have our first stage accumulation. And then as you can see, there is a gap that is nested right below it right here that we do tap into. So this would be your low risk buy, or this would be your entry that you could take. And then you have your retracement right here at around the -2 to -2.5 level. So this is where you have your retracement. And then as you can see, what it does once it goes into this level, it retraces back to internal liquidity at around 50% of the range. So right here you can see we go just below 50% of the range, and this is just our retrace. Because when we have a retrace, we don't want to see it retrace that's above, that only stays in a premium. You want to see it go into a discount of the range that we had just formed and make another reversal in order for the retracement to continue higher. And then right here, you have your -4 to -4.5. So this looks like a potential area that the market could potentially reverse from. This is on the daily chart, as I'm saying. So this is our high time frame, and this is the swing that we've kind of had since October, all this move up, making all-time highs. So this helps me accurately predict where might we top in the market, but as I said, it's not always perfect in almost every single way. The phases of these are just only to anticipate it. But when we close above a phase, so when we closed right here above the -2, -2.5, then that's how I know that we're going to continue and go up into the -4, and that'll be our next area where we might see a reversal. But the -4 can also just be a retrace right here, like as I said. And then what we can use is we can use our manipulation leg that we have right here. Yes, sometimes I do use whole candles like this. And then as you can see, we might have another market maker model setting up as well. -1, -1.5, there's a fair value gap nested right below it. And we are just now tapping into that fair value gap. So if this holds, then I'll expect us to have higher prices coming into here. And the reason I'm using this candle right here is because this was our week 2 manipulation. So accumulation right here. Week 2, we dropped low, take out these swing lows, tap into a PD array, and then we continue higher. And that is the reason why, not as always, you can't just blindly short at this -4. You have to understand what's the narrative. Are we in a trending market? Are we likely to go up? Are we displacing above highs? But this is just for me, this is such a shallow This is such a like shallow liquidity sweep that it makes me think that if we were to reverse, we probably would have done it already. And the fact that there's no SMT at these highs, so this really can't be manipulation. But there is SMT at these lows, so this tells me that this leg is going to be the manipulation, and that we can expect another market maker model to form right above the -4, -4.5 area that we have on our main. This is our main range, but then every single time we come down here and we make new lows, you can now use that to project the next range that will be formed, and so on and so forth. But this is just a really nice example of the manipulation leg. I'm sure you guys seen a ton of people use this example, but overall this is just very clean in following the market maker model. Very clean price action. Once you kind of looked on a high time frame and you kind of understand, okay, we got a retracement here, then you'll be looking for buys. And yeah, that just helps. It just helps me with confidence and just anticipating where we can make that high. Here's another example. So this is our wick, so our open to the wick example that I'll use here. And the reason why I'm using this specifically is because we know that when we come above the open, this is going to be our manipulation, and that this is going to be our Tuesday high of week, right? So essentially, when we're trying to predict our market maker models, and we already see that we have some kind of initiative and some narrative to go lower, then what we can use is we can use the wick to the high. So this is going to be our manipulation, and we can use this to cast out where price could deviate from this wick. So this is what I mean by deviations, is that when you measure out this wick 1 to 0, -1 is mirrored, -2 is just a second deviation of this, and then the -3 is your third. So like imagine you're placing a box like this, and you're just duplicating it. So I'm just gonna clone it, and then you just move it 1 below, and then clone it again, and then you just move it 1 below. And you can see kind of the algorithmic signature that this kind of holds, meaning that when we create this high and when we create this wick, you can kind of understand that, okay, this is likely where we're going to project from. This is the -2, -2.5, where we see our retracement. And where does that retracement happen at the -2, -2.5? Right back up above into a premium, above into the open, and then we redistribute back down to -3.5 to -4 deviations to then restart the cycle again, where we can see once price has reached this area, then we can expect another retrace into that 50% of the dealing range and right above it into a premium, and then see some movement lower. Or like I said, this week was pretty void profile considering it was an end of the month. But you can see even with choppy price action, it still can work. And if you kind of are unclear and we kind of have this really weird like manipulation, there's not much SMT here, but you still think the draw is lower for whatever reason, maybe inside of this discount 60-minute SIBI, hourly SIBI, or sorry, BISI, my bad. Then you can expect maybe price is going to, come down to the -3.5, and you can see this lines up really perfect with, I believe, EQ of this SIBI, if I'm not wrong. I'm not sure. Yeah, it doesn't. I mean, they line up like decently well. You can see that this does line up pretty well with the EQ of the SIBI. So that's what I mean when I say that you need to understand, you can't just use this blindly. There needs to be some reason. There needs to be some draw on liquidity that you can use. And then once we've hit a level, then you can anticipate a continuation, because you can see it's respecting these levels. But we know that sometimes it can just reverse. So, maybe right here, I think I'm bearish, but the fact that we have a target lower, I think I'm bullish, but the fact that we have this target lower here makes me think we'll hit the -3.5 to -4 standard deviations and then return back up. So there needs to be some, like I said, there needs to be narrative involved. There needs to be like a basic understanding of the candle anatomy to use this. And this is like I really like to use this, especially on a daily candle. I'll try to find a good example. So we'll take, let's see. Go on the daily and see what we can, so like for example, I'll use like this right here, and then, I mean, this isn't the greatest one, it's not the biggest wick, but you're welcome to also use this one as well. This one's a little bit of a bigger wick, and then you can see the -2, -2.5 that we kind of reach into, respect it, and then now we're retracing into this fair value gap, and we're holding it pretty nicely, and we have SMT between these lows as well. So that tells us that this 2.5 is just a retracement, and that we'll be going higher by projecting the wick that was made during Tuesday, low of week compared to Monday. So when you have your manipulation and you see this Monday candle, but then Tuesday sweeps it, you can use the wick, you can use the open to the wick, and you can cast it out forward, and then you can see where we might create the high, and you can also see that this lines up pretty well with our liquidity target, which was our week 1 high. So that's another example of when you can use the wick to the open, or the open to the wick, or the open to the wick high, and then you can use that to project it as well. Like I believe right here, you can use this one, and then you can see -1, -1.5 deviations, and then maybe you could come hit this low, but it's highly unlikely. So this one I wouldn't use because the draw isn't in alignment, or sorry, the order flow is not in alignment with it, and there's no SMT here, so this isn't really like a clear manipulation that you can use, because I only am really using the wick to open when we have manipulation. We've already swept some liquidity, and yeah. And here's some key takeaways that I want you guys to use and look in your own charts for. Don't take my word for it. I want you guys to really look through your own charts. The market is going to be the best teacher, better than me, honestly. The market will teach you more things than me, and I've found out most of these stuff mainly through learning from other people, such as Dexter, such as Romeo, and such as ICT. And I've kind of just reinforced this idea, and I've really studied it in my charts. Like I'll go in every week, I'll try to pull up a standard deviation fib, and I'll just try to see like really where I can anticipate it. So on any time frame, I want you guys to identify the breaker deviation, the manipulation deviation, open to wick deviation, and distribution deviation. And I want you to ask yourself these questions. When you're using any of these deviations, which one lines up with liquidity? Does it align with our high time frame order flow? And there's any areas within the deviation that I can enter in. So let's say you see like a -1 to -1.5, and you see the fair value gap above it. I want you to be like, okay, this is a potential entry that I can use, and then I can target the -2, -2.5. Essentially, what we'll be doing is, like I said, the breaker, manipulation, open to wick, and distribution, they kind of all are the same thing, because this kind of stuff happens within the wick of a higher time frame candle. When you have your distribution leg up, when you have your open to wick, like when you have your manipulation, when you form your breaker, that is all going to be within the wick of a high time frame candle, and you can realistically use any one of those. It's just which one lines up better with liquidity and which one aligns with the high time frame order flow and high time frame narrative. And this will help you kind of understand which ones to use in which situations. Maybe the manipulation doesn't present itself, but we have our distribution. Maybe the open to wick is very small, but you can go on a lower time frame, and you can see maybe a 1 minute or a 5 minute manipulation leg that you can use, a B2C leg that you can use to project your deviations. Or maybe we don't even print a manipulation, and maybe we don't even sweep below. Maybe we have SMT, and then we immediately go up. Then you can use your distribution deviation and see if that one lines up with liquidity. So that's basically the premises of it. I tried to make this a bit of a shorter video, but if you guys have any questions, please feel free to reach out to me on Twitter, in the comments, anything like that, and I will make sure to answer your questions. And if you guys maybe want a more deeper understanding, I really recommend watching Dexter's video. I'll put it on the screen right here. I really recommend watching that video, because he's like really the true guy with standard deviation theory, and he really reinforced the theory and made it what it is today, and where I learned most of it. But I'm just sharing you guys my interpretation of the standard deviation theory, and yeah, I hope you guys enjoyed, and take it easy.